Welcome to the Byte-Size Brief. Today we are putting PACCAR Inc., PCAR, that's PCAR, completely under the microscope. Let's get into it.
Yeah, I am really looking forward to this one.
Right, because we've got a massive stack of sources today. I mean, we're looking at everything from their Q1 earnings to the latest EPA filing.
And some pretty unfiltered stuff, too.
Oh, totally. We even pulled raw threads from the Our Truckers subreddit just to see what the actual drivers are experiencing.
Which is crucial context, honestly.
It really is,
Yeah.
because the mission today is to figure out how this company is pulling off what looks like an absolute magic trick.
It honestly does feel like a magic trick,
Yeah.
especially when you look at the heavy truck market right now. It is just brutal out there.
Brutal is like an understatement. It feels like stepping into the twilight zone.
Yeah, the numbers aren't pretty for the broader industry.
No, they aren't. The North American market is currently in a 27% sales slump. That's a crater. It's like the whole freight industry, just skip breakfast, lunch, and dinner. But then you look at PACCAR Inc., PCAR, and they just posted their fourth highest profit year in their entire 120-year history.
Which is just wild.
I know. We are talking $2.64 billion in adjusted net income, and that's on $28.4 billion in revenue.
It's a remarkable divergence, honestly, because you have to remember, commercial trucking is a highly cyclical industry.
Right, it goes up and down with the economy.
Exactly. When consumer demand drops, freight demand drops. And when that happens, fleets stop buying new Class 8 trucks, those massive 80,000-pound 18-wheelers.
Yeah.
Usually, manufacturers take a synchronized hit to their bottom line. But what we're seeing here with PACCAR Inc., PCAR, is this complete decoupling of profitability from raw delivery volumes.
Yes, I was trying to visualize this, and it's like walking past a restaurant at prime time, looking through the front window, and seeing the dining room completely empty.
Oh, that's a great way to put it.
Right. You'd think they were going bankrupt. But then you look at their books, and they are making absolute record profits. The front of the house is quiet, but the back of the house is printing money off like their secret takeout sauce.
That is the perfect analogy. And our agenda today is to decode exactly what is happening in that back of the house.
Let's do it.
To understand how PACCAR Inc., PCAR, engineered this capital-light platform, we have to look at a few things. First, their high-margin modes. Then, a massive impending regulatory price hike.
Which is huge, by the way.
It is. And finally, because we have to look at the downside risks, we're going to dig into some very concerning insider selling from their executive suite.
Okay, so compared to last quarter, what actually moved the needle here? Because looking at the numbers, things were looking a bit messy in Q4 of 2025.
Messy is definitely the right word.
Oh.
But it was a calculated strategic mess.
Okay.
To understand that Q4 dip, we really have to talk about Section 232.
Right, the national security tariffs. Usually we hear about those with raw steel and aluminum, right?
Exactly. But lately, it's been weaponized against commercial imports. They placed heavy taxes on imported commercial vehicles and chassis components.
Well, oh, gotcha.
And those Section 232 truck tariffs hit hard on November 1st. But PACCAR Inc., PCAR actually saw this coming.
So they didn't just sit there and eat the tax.
No, not at all. Instead of passing it to the customer, they decided to perform some incredible operational gymnastics mid-quarter.
Like what?
They completely shifted their medium-duty truck production out of their facilities in Canada and Mexico and moved it straight into Chillicothe, Ohio, and Denton, Texas.
Wait a second, I have to push back on that. Retooling an entire commercial assembly line mid-quarter,
Shit sounds crazy, I know.
moving supply chains across international borders while you are still trying to hit production targets. That usually spells absolute disaster for quality control. Did they actually pull that off without massive defects?
Well, it was incredibly disruptive, which is why you saw that financial hit in Q4. I mean, you can't just flip a switch.
Right, you have to retrain everyone.
Exactly. You reroute supplier logistics, calibrate new robotics, retrain thousands of workers. Because of all that friction, their gross margins dropped to 12% in the fourth quarter.
Ouch.
But it was a tactical retreat. They did it to establish a strict local manufacturing strategy. And the Q1 2026 payoff is immense.
Let's hear the payoff.
Because they avoid those import taxes entirely now, their gross margins are projected to jump right back up to a very healthy 12.5% to 13%.
Hold on, how does that actually affect PACCAR Inc., PCAR stock price for regular investors like me? I mean, it sounds great for their accountants that they dodged a tariff, but
Yeah.
what is the real-world impact on the showroom floor?
The real-world impact is that they just handed themselves a massive pricing advantage over every single competitor.
Oh, really?
Yeah. Right now, rival truck makers who rely on imported vehicles are bleeding. They have two terrible choices.
Which are?
Either absorb the import taxes, which destroys their profit margins, or pass the cost onto the fleet customer with massive surcharges.
And that just kills orders.
Exactly. It immediately pauses orders. Meanwhile, because PACCAR Inc., PCAR, localized production, they completely removed their tariff surcharges for 2026.
Oh, wow. So while everyone else is apologizing for jacking up prices, they are walking into the dealership and saying, hey, the price on the sticker is the price you pay.
Precisely. No extra fees here. And fleet managers vote with their wallets,
Makes total sense.
That pricing clarity is driving a massive surge in market share. Actually, their U.S. and Canada Class 8 truck retail market share recently hit 30%. Dealerships are rushing to place stock orders with PACCAR Inc., PCAR, because they actually know what the final invoice will look like.
That is a brilliant pivot. But let's be honest, selling cheaper trucks, or at least competitively priced metal, isn't actually where the real money is made anyway, right?
You're exactly right.
It's what happens after the truck leaves the lot.
And that brings us to the core of their profitability, the real back of the house, going back to your analogy.
You mean the numbers?
The data is staggering. 71% of PACCAR Inc., PCAR's total profit, now comes from just two divisions.
And neither of them are making new trucks?
Nope. First is PACCAR Parts, which just posted a record $6.87 billion in revenue.
Wow.
And the second is Financial Services, which brought in a record $2.21 billion in revenue and now sits on a massive $22.8 billion in assets.
So basically, it's kind of like the inkjet printer model. They sell the truck at a competitive price, but make the actual gold on the ink, or in this case, the financing and the replacement parts.
That is a highly accurate analogy. It's a very sticky ecosystem.
Right.
The Financial Services division originates the loan, structures the lease, and often ties it to long-term maintenance contracts. It's so lucrative that global competitors like Daimler are desperately trying to build out similar aftermarket networks globally.
Right, but what does all that actually mean for PACCAR Inc., PCAR investors? Because knowing competitors want to copy them doesn't put money in the shareholder's pocket.
It means guaranteed recurring revenue. It acts as a shock absorber against that 27% sales slump.
Okay, I see.
And here is the immediate measurable catalyst for PACCAR Inc., PCAR. Right now, there are exactly 380,000 PACCAR engines currently crossing the 5-year mark.
Okay, why is 5 years the magic number?
Because year 5 is the exact age in a commercial truck's life cycle where parts consumption absolutely peaks.
Ah, the warranties expire.
Yep, the initial manufacturer warranties expire. Heavy wear and tear items like fuel injectors and emissions filters, they need replacing. So if you manage a fleet, you have to maintain the trucks you bought 5 years ago just to keep them on the road.
So PACCAR Inc., PCAR, has a captive audience of 380,000 engines entering that exact window right now.
Exactly. It's an incredible built-in safety net.
But, to keep that parts revenue flowing, you need trucks constantly running, and the drivers are telling a slightly different story.
They certainly are.
We did that deep dive into the Trucker subreddit, and the raw feedback from the drivers out on the highway is fascinating.
It's a real tale of two perspectives. If you ask a driver about the physical cab, they absolutely love Peterbilt and Kenworth.
Which are PACCAR Inc., PCAR's flagship brands.
Right. They praise the ergonomics, the seating position, the sleeper cabs. But when it comes to the engines, they vent heavy frustration.
Heavy frustration is putting it mildly. Some of these drivers are losing their minds over PCAR engine reliability.
Yeah, the DEF issue specifically.
Right, the diesel exhaust fluid systems. Drivers are complaining about incredibly fragile sensors, electrical faults, and endless software bugs, especially for trucks with extreme idle times.
Which wreaks havoc on the diesel particulate filters. They get clogged with soot, a sensor trips, and the truck goes into limp mode where it can only drive like 5 miles per hour until it reaches a dealer.
Wait a second. If the trucks are constantly in the shop with sensor issues, isn't that a massive red flag for the brand's reputation?
You'd think so, right?
Yeah. If I'm an investor, hearing the core product keeps breaking down makes me incredibly nervous.
It's a financial paradox, honestly. While downtime intensely frustrates drivers, required maintenance on highly complex systems is exactly what drives that record 29.5% gross margin in the parts division.
So the breakdowns are actually subsidizing the profit margins. That's wild.
It is. When a software fault occurs, an independent mechanic can't just wrench on it. It requires a secure connection to the manufacturer's network, and PACCAR Inc., PCAR, captures that revenue.
I see.
And this ties into their broader fast follower R&D strategy. PACCAR Inc., PCAR, spends significantly less on R&D, around $450 million to $500 million, compared to massive rivals who spend billions.
They just wait for others to make the expensive mistakes.
Precisely. They let the others burn cash, and they only jump in when the market is ready to pay a premium.
But they aren't waiting around on everything, because PACCAR Inc., PCAR, is aggressively front-running two massive industry shifts hitting right now in 2026.
Yes, they are leading the charge on the impending January 2027 EPA NOx regulations.
This is the big shock.
It is. The EPA is limiting nitrogen oxide emissions down to just 35 milligrams. Management has explicitly warned customers this will add a massive $10,000 to the price of a new truck.
So it's like shoppers rushing the doors right before a massive Black Friday sale ends. Fleets are going to order everything they can in 2026 to avoid that $10,000 penalty in 2027.
Exactly. It creates a classic massive pre-buy cycle. You are heavily incentivized to refresh your entire fleet in 2026.
Which sets them up for a massive order surge.
Right. But the second catalyst might be even more significant: autonomous commercialization.
The robot trucks. Talk to me about the Aurora Innovation Partnership.
In Q2 of 2026, PACCAR Inc., PCAR, is set to launch commercial driverless operations for the Kenworth T680 and Peterbilt 579. We are talking fully autonomous, revenue-generating freight movement at scale on public highways.
Removing the driver entirely. That is the holy grail.
And it positions PACCAR Inc., PCAR, as the very first legacy OEM to offer a fully autonomous platform at scale. It introduces what we call agentic AI into the vehicle.
So the AI won't just steer, it will literally book its own maintenance.
Exactly. It acts as an intelligent agent, proactively routing itself to a dealership when it detects a failing part.
Okay, so with a massive pre-buy cycle coming, tariff advantages, and robot trucks hitting the road, the stock seems untouchable. But what are the hidden landmines here?
The bear case is definitely grounded in real financial risk. First, PACCAR Inc., PCAR, just took a $350 million pre-tax charge for European civil litigation.
What's that about?
It's related to an EU truck cartel price-fixing case. It's a stark reminder of persistent regulatory risks in this industry.
A $350 million fine is definitely a massive chunk of change, but there's a bigger red flag, isn't there?
Yes. The biggest warning sign right now is insider selling.
Uh-oh.
In the last 90 days, PACCAR Inc., PCAR executives, including the CEO, R. Preston Feight, and multiple EVPs, have sold off 130,905 shares.
Wow.
They've cashed out roughly $16.6 million just recently.
Okay, if the 2026 pre-buy is going to be so massive and the tariffs are playing right into their hands, why on earth is the C-suite cashing in their chips right now?
It's the ultimate question.
I mean, if the insiders are selling, why should regular investors be buying?
We have to weigh it objectively. On one hand, regular insider selling is often just standard executive compensation vesting. People need to diversify or pay taxes.
Sure, that happens all the time.
But on the other hand, the stock is currently trading near all-time highs, around $111 to $115. A bear would argue that management knows the 2026 pre-buy will artificially pull demand forward, creating a massive sales vacuum in 2027.
Because nobody is buying trucks next year if they all buy early to dodge the EPA fine.
Right. If executives believe the stock price is fully baked in that 2026 surge, they might be signaling that the valuation is fundamentally peaked for this cycle.
That makes a lot of sense. The stock market is forward-looking.
And it brings us to a larger existential shift. As these trucks evolve from mechanical hardware into iPhones on wheels, the core business model is changing. They are becoming incredibly reliant on subscriptions and that agentic AI.
Which totally transforms the industry.
Right. Leaving us with a critical question moving forward. Will PACCAR Inc., PCAR's traditional dealership model, be a competitive asset, or an expensive, outdated liability compared to direct-to-consumer tech disruptors?
Now that is a fascinating question to chew on. All right, listeners, what's your take on the future of PACCAR Inc., PCAR? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.